Well, thanks everyone for tuning in to this video. I'm excited to have Sylvia Kwan, Chief Investment Officer of Ellevest, and one of the authors of this most recent Crossing the Threshold thought leadership piece that we just recently published. Lots of good takeaways, tangible takeaways as part of this piece. We really tried to make sure this was practical, and we're going to try to tease some of that out a little bit more in this one-on-one conversation with Sylvia. So first and foremost, Sylvia, thanks so much for your participation in both this piece, but also all the numerous other things that you do with us.
Well, thank you. It's great to be here, Aaron. Thank you so much for inviting me.
Great. Well, let's get into it. And one of the things that I wanted to talk to you about is when you look at this piece, just across all the different authors that we put together, we've kind of got this cool metaphor that we've tried to maybe retrofit to some of the more practical elements of alts and wealth management. And the overarching theme of this is that integrating alts into a wealth management practice is a journey. And we talk through that whole kind of literary concept of whether you're watching a movie or you're reading a book that's got an adventure or a journey element to it. There's that call to adventure. There's kind of the struggle as you start to go on that adventure. And then eventually you go off on the adventure, come back, completely changed from who you were, or maybe better and evolved from who you were when you first started. So maybe just as a first question to you, Sylvia, I'd love for you to just kind of react to that metaphor, that concept that we've put together and as part of this piece, and how you see kind of the journey more broadly across the industry of taking alts, which is still relatively new to a lot of wealth managers, and integrating it into an existing practice.
I love the metaphor, Aaron, that alternatives and integrating alternatives really is a journey. It really is a process. And when you were talking about it and I was thinking about it, as we think about traditional investments like, publicly traded stocks and bonds, right? Because of the nature of those investments, it's you have a strategy, you implement the strategy, and I wouldn't say completely done. Obviously there's ongoing monitoring and things like that, but the implementation is pretty straightforward, I would say. For alternatives, that's really not the case, and so that's what I love about it. It really is a journey because several things actually. There's so many different types of alternatives. um, it's never a really kind of set it and forget it type of strategy. Like, you could actually do that with stocks and bonds, and in terms of, putting it into a low cost index fund, and then you might be done, have some rebalancing. But really with alternatives, the universe of available investments is constantly changing and it's constantly growing. And I think these days it's expanding and accelerating faster than ever. And so, as advisors, as wealth managers that are in this industry, it's certainly a educational journey, both for us to keep abreast of everything that's going on in this field, both the types of investments as well as the different fund structures and different ways to access them. It's certainly a journey with our clients, educating them, helping them understand why, if it makes sense for their portfolio, and why, educating them along that. And then, of course, um, implementing alternatives often is not something that you can decide today and then be done tomorrow. For a number of alternatives, especially ones that have longer horizons, it may take a few years, maybe even longer, to actually fully implement that type of portfolio. So in so many ways, I would say, integrating alternatives is very much like a journey. And I would say it's like a journey with almost no end. Because I feel like you're never really done. And, I would say that in the financial industry in general, you're never really done. It's not like you figured it out and you're done. There's always, because of the dynamic nature of the market environment, you're constantly adjusting and reevaluating to do what's best for your clients.
I love the way that you talked to, it's never really done, and it's true when you look at investments or the financial industry. I mean, we're constantly changing, evolving. There's new products that come to market. There's new asset classes that come. alts, is a good example. I mean, just 20 years ago it was completely different in terms of the makeup within the alternatives categories today, relative to today. It's almost a completely different market. Some are more mature, some are, still in their infancy, and there's a lot to learn there. One of the other things I like that you kind of highlighted of the education journey is those three components. There's the advisor kind of directly sitting in front of the client and understanding alternatives. There's the client themselves, and that's a completely different educational journey, as I'm sure you can attest to, and different types of clients, preferences, all of that kind of stuff. And then the operational side is really important as well, because as you said, it's not really a set it and forget it, easy to buy a ticker, and then you're kind of done until you go in for rebalancing. There's capital calls, there's cash flow management, taxes, reporting, all of those kind of things. So I think those three kind of verticals are an important piece of the journey.
100%. I'm glad you brought up the back office, because that is one thing that I neglected to talk about. It is definitely a involved process. And that's, I would say, also part of the client education is helping them understand that it is not like, buying a stock and being able to, buy it today, sell it tomorrow, but how does alternatives work and why and what to expect, as a client who is investing in these types of things. And yeah, back office is definitely something that I think investment financial advisors and firms who are integrating investments have to really pay attention to, because often some of those things can be surprises to clients, and they're not always positive.
Yes, yeah, and certainly after I'd say the past 5 to 10 years, where technology has gotten so efficient on the traditional side that you're almost having to like go back and say, okay, I've got to start over to some degree. I mean, we've got things in place, but it's just a whole different workflow and process. So it's an important piece.
Yeah. And it's, I think that the last thing that I would like to mention is, I would say that integrating alternatives into client portfolios is much more of a hands-on type of process, where you're really rolling up your sleeves, getting to know, in many cases, the fund managers of the alternatives and building that relationship. I think that's another difference between investing in alternatives versus investing in publicly traded stocks and bonds or funds or ETFs, is you're really digging deep, building those relationships, and that has actually, we have found in our experience, at least, that's been quite a positive in terms of successful integration of alternatives.
No, absolutely. And we talk about performance dispersion just on the quantitative side, but there's a lot of qualitative elements to that as well, in terms of service and being able to get someone on the phone, and if you need something. So 100%. Sylvia, when you look at Ellevest, you all are super users. If I can categorize you that way, in terms of your private markets exposure and alternatives exposure in your portfolios. So you might think that this came easy to you when you first started off, but maybe just talk through kind of the journey that you went through, whether it's pre-Ellevest earlier in your career, maybe the Ellevest journey as well, like some of the things that were bumps along the way, success stories, things that you took away as you went from maybe more of a novice to now what you are now, which is kind of alts as the core super user type of investor.
So, Aaron, I think I would say there were two things really that influenced my thinking around alternatives and kind of started this path towards alternatives. I started investing in alternatives or private investments prior to coming to Ellevest in an earlier practice. And that was really driven by two things. One is I had a client who was very interested in investing in investments that could also make some kind of positive impact. And so she wasn't really attracted to the public markets, because there was very little control in terms of the types of companies that you can invest in. And she really, it pushed me in some sense to look deeper and further. What else, what other investments are there that could both earn a return as well as some kind of positive impact? And I would say the second influence is I am on the investment committee of a fairly large college endowment. And this endowment leans very heavily, as many do, into alternatives and private investing. And so being on that board for a number of years really exposed me to, I would say, the power of alternatives and the ability of alternatives to really add value and really help diversify a portfolio of traditional assets. And so the combination of those two, kind of alternative investing as a value add to portfolios, in addition to, hey, being able to make an impact, the marriage of those two is kind of really what came together at Ellevest. And so joining Ellevest, and when we started our private wealth practice, one of the things I really thought hard about is, how are we going to differentiate ourselves, and what is going to be different about us? Why would someone join us as a client? And it was really the marriage of these two. So I knew I wanted to lean into alternatives. So I didn't want portfolios to have, 2% alternatives, 5%, just because I don't think that really moves the needle. So really having a heavier allocations to alternatives, and then having those alternatives both serve an investment function in the portfolio as well as some kind of impact function. And so that's where we started from the very beginning, which I think is unique and unusual. I think most firms, have been around obviously much longer than we have, and then they will start kind of maybe a division or a small team that maybe invest in alternatives or impact, but our entire practice is actually built around this. And so, as you might imagine, it was pretty slow going, and it was really hard at the beginning to do this, because we didn't have as many options as we did today, and then we also very small, so it was hard to get fund manager attention, things like that, and sourcing was definitely a challenge. All of these things, right? And I would say it took probably 2 to 3 years to really build up to where we are today, where there's just a lot of interesting alternative investments out there that really help to achieve client goals. Their risk range is very wide, and there's just a lot more options out there, both fund structures, underlying investment strategies, and as well as areas of different impact. And so it definitely takes time, and it was just a lot of just, boots on the ground, talking to anyone who would talk to me, going to conferences, telling them what I'm looking for. And today it's, I feel like all of those little seeds that I planted, 5, 6 years ago are finally kind of coming to fruition and coming to harvest. And I will hear from people I haven't talked to, 4 years ago, who have moved and said, hey, I know you're looking for alternatives and impact, this is what I have. And so now it's super fun to actually be in the space, but it did take quite a bit of work and sweat and tears at the very beginning.
Yeah, I was gonna say that relationship element on your last point again, like such an important piece of all of this. Maybe just a follow-up question. So obviously, size of your firm and the options that are available are key important pieces to kind of getting up that curve. Was there anything else that, like, this was kind of the thing that we did, or this was the moment where it all kind of started, to become a core piece, or made it a little bit easier, whether that's an exogenous event of people starting to know who you were, or something you did internally with operations or your advisors? Like, what can you identify what that moment might have been?
I would say it really was a confluence of things. I think we were seeing more demand from clients for impact related investing. And so, from client demand coming to Ellevest specifically for this, to us, I was like, oh, wow, okay, we intentionally built this to have this differentiator. And now I feel like, oh, it is the differentiator now to have these. And I would say also on the investment side, not being afraid to look at new managers and emerging managers, younger managers. It takes a bit of courage, I would say, and it's certainly, deeper due diligence. It's not like we, invest in all first time managers. But when I think about, for example, one of our very earliest fund managers, when we started with them, they were maybe under 200 million of assets under management. And we were one of the earlier RIAs working with them. And now they have, well over a couple of billion. And I think building those relationships early, where you're kind of growing up together in some sense, is really important. And I think I have found that has been very successful in terms of identifying great managers who might have track records elsewhere, but this is their first fund. Having a belief in that manager. It's really a two-way street in many ways. And so once you kind of have built that relationship, even though you might be small, you become an important relationship, and those relationships beget other relationships, and it kind of grows from there.
I like the maybe this is the overarching theme of kind of finding your niche and kind of what differentiates you. And a lot of people point to the Yale model or the endowment model as kind of the this is the thing we aspire to be. But as I talk about in my section of this report, you can't be Yale. Yale is Yale, and they've got their own way of doing things. And some of the things that you said over the past couple of minutes of like focusing on impact and being bold and investing in the emerging managers, like those are some of the differentiators that has kind of made it successful for you. One of the other things that, and I know you've been a huge advocate for this and you write about it in the piece, is this whole goals-based element to investing. And you talk through that in pretty good length throughout your section, but I'm very curious, beyond just kind of introducing what goals might be, which is, I think, the first step. Was there anything that you did as you started to communicate this to clients in the context of alts that resonated with them? Like, what were some communication things that you did, or ways that you kind of built that goals-based framework in a way that the aha moment for clients, or the light bulbs start to go off?
Talking of journeys, Aaron, it definitely was a journey to really educate our clients and figure out what was going to really resonate. As you might imagine, many clients are alternatives are new to many clients. Even very sophisticated clients and very ultra high net worth clients may not have invested in alternatives before. And so what we found over several years of trying different things and finding different approaches and different frameworks, is a couple of things. First, we try to relate it to what people know. That is always very helpful. And so most clients will know, what is a stock, what is a bond, when they know that stocks are riskier, higher risk, higher return. Bonds are lower risk, lower return. And so what we did was we laid out the different alternatives along a kind of low risk, high risk spectrum, and kind of talked about like, oh, these kind of alternatives are more like stocks because they have much greater risk because of these reasons. If you think about private equity or venture, obviously, I think people can understand, oh, they're private companies and they're riskier than public. And so that's why they're way over here on the right-hand side versus, say something in the middle, which we classify as more real estate. Hey, there's a bond-like component in the terms of there's, rental income coming from this. And there's also the possibility of capital appreciation. So similar to stocks. And so laying everything out, even though they may not be familiar with that specific type of alternative, laying it out in kind of that more bond-like, more stock-like, something in between, really helps them kind of anchor a little bit and say, oh, okay, I get it now. And it is also really helpful when you're building an alternative kind of portfolio, or even that part of the portfolio, helping them understand, hey, we don't want to just invest in one or two types of alternatives. We really want a diversified allocation to alternatives. And here are all of the things along this risk spectrum that will contribute to your portfolio. And it really, really helps the conversation to relate it to what people know. The second thing that we found is starting with alternatives in asset classes that our clients are a little bit more familiar with. And so real estate, I think, is a great example. Most everybody understands what real estate is. They may own a home or they rent a home or what have you, but they know what it is. And it's also very tangible and real. And so, if somebody is new to alts, we don't, say, oh, let's invest in these three venture funds like that. We don't do that. We start with something that they know, for example, in real estate. And so once they have kind of that experience and understand the client experience with respect to things like capital calls and how you're investing over time, it's not just one time. They're kind of getting their feet wet. They're getting familiar. And then it may take, a few years, but I feel that those small actions and relating it to something that they're familiar with has been really the key to educating our clients and getting them very comfortable and actually enthusiastic about investing in alternatives.
Yeah, I think the communication around this is so important because on one hand, you want to differentiate yourself as an organization and look what we're doing in your portfolio. We might own these particular strategies. On the other hand, you can't talk over your client. You kind of got to meet them where they're at and kind of whether it's the way you talk about it or where you start. I think is such an important piece because otherwise, then you're just trying to sound smart at the end of the day, and it doesn't really hit home with a lot of these different clients.
Exactly. That's exactly right. And we feel the more our clients know, the better. Right. We don't wanna be those who are like, "Oh, just trust us, this is good for you." Like, that just never works, and it also helps us to engage our clients when they understand, like, "Oh, this is why, we're adding this to the portfolio, it's gonna help, lower overall portfolio risk or provide income or inflation protection," or whatever the situation. It's having that understanding and then actually seeing it play out, as market dynamics change. That's really what. So one thing interesting that I do want to mention about sort of experiences. For the longest time, we talk about, why are we adding alternatives, right? And one of the really, I would say, most important reasons is really diversification, and to offset the risks of publicly traded stocks and bonds. And so we are very focused on those kinds of alternatives that have lower correlation with what's happening in the market or what's happening with interest rates, et cetera. I mean, obviously, you can't go to zero, but that's kind of the purpose of it. And so our clients have heard us talk about it ad nauseum, like diversification, diversification. They're like, okay, I get it, I get it, I get it, right? And then 2022 hits, and then they're like, oh, I really get it now when they see this statement. And so sometimes it takes something like, not that I would wish a 2022 happening, but sometimes it takes the market environment to really help a client really understand, okay, in theory, diversification, great. But hey, in reality, I understand now. And that actually was one of the silver linings, I would say, of 2022, is helping our clients understand that.
Yes, yes. Never a better teacher than pain sometimes.
That's right.
um, Maybe in the final couple minutes here, Sylvia. So again, going back to this journey concept, and you talked about industry journey, your own journey. For those that, and maybe let's do this in two types of people. For those that are just beginning that journey, they're at zero, and they're like, I know I'm going to try to do this, or I've got to do this, and my firm wants to do this. And then there's the people that are, let's say, bought in to some degree, but are trying to jump to that next level. What pieces of advice would you have for both of those types of people or organizations? And maybe they're the same thing. I'm not sure, but what would that advice be as they're starting that journey?
I think the my advice, first of all, for both groups is fairly similar. I think with the proliferation and popularity of alternatives, I do get this question a lot from some of my peers who are starting out. Where do I begin? It's a very overwhelming when you think about the world of alternatives and all the different options, all the different managers, all the different fund structures, and sometimes it's really paralyzing to say, okay, where do I begin? And I think to help advisors who are starting out or even those that are in the middle, I think the best way to begin is really understanding the purpose of the alternative that you want to add to your client. And it could be that you might have a practice where alternatives may not be appropriate. But if you can understand what is my purpose of adding alternatives and what is the purpose for this particular client, the um, kind of the, I don't want to call it a problem, but it becomes a lot more manageable to get started, right? Because you've now narrowed down that universe to very few. And it's not to say you have to figure it all out on day one. You might just say, hey, a lot of my clients are, they're in dividend stocks, they're really looking for more of an income oriented portfolio. So you might say, hey, I think what would be really great is if I could add some alternatives with different sources of income to the portfolio. And now you've kind of narrowed that entire space. And like, now I'm really focused on alternatives with income. So that eliminates a lot of the private equity and venture for now. But that allows you to focus on something instead of saying, oh, here's this big wide world of alternatives. Like, how do I do this? And how do I, it makes it very, very difficult. So the more you can kind of filter down and really focus, and think of it, and we'll go back to, again, this is a journey, right? Let's start here. It doesn't mean you have to figure everything out on day one. Let's figure out one thing at a time. And maybe it is just income. And maybe that means, real estate or something like that. And that way you can just focus on a smaller universe of possibilities. And then you can think about, okay, what would be the right fund structure for my clients? Maybe some clients don't need liquidity, maybe some do, and you can narrow it further. And so that's why I always start with, what is the goal of adding alternatives for this client? And then starting there, and then that will allow you to really get started in small steps, because it is a long journey, and you gotta save energy for the journey ahead.
Great. Well, Sylvia, any final thoughts or final words before we sign off?
I think although it may feel very challenging, this kind of world alternative, and especially since a lot of investment managers aren't in it, and you don't know, who and et cetera. I would say the more you can break it down into smaller chunks, I do think it is adding alternatives, and I think being on this journey is extremely rewarding and definitely worth the effort.
Great. Well, with that, thank you so much again for your contribution to the piece and for this conversation. Hopefully, people find it helpful and have some good nuggets to take away as they begin their journey.
I hope so too, Aaron. Thank you for having me.